Constructing a cash flow statement involves a detailed process that tracks the inflow and outflow of cash within a company. Here's a step-by-step guide to creating one. Gather financial statements. Start by collecting the company's income statement and balance sheets for the relevant periods. These documents provide the data needed to prepare the cash flow statement. Determine the cash flow method. Choose between the direct method and the indirect method. The direct method lists cash inflows and outflows directly, while the indirect method adjusts net income for changes in balance sheet accounts to reconcile to cash flow from operating activities. Start with operating activities. If using the indirect method, begin with net income from the income statement. Adjust this figure by adding or subtracting changes in working capital accounts, such as accounts receivable, accounts payable, and inventory. For the direct method, list all cash receipts from customers and cash payments for operating expenses. Adjust for depreciation and amortization. Add back non-cash expenses such as depreciation and amortization to net income. These are deducted in the income statement, but do not involve actual cash outflows. Account for changes in working capital. Adjust net income for changes in working capital items. For example, increase cash flow if accounts payable increases or decrease cash flow if accounts receivable increases. This step reflects the cash impact of changes in current assets and liabilities. Calculate cash flow from operating activities. Once all adjustments are made, the resulting figure represents cash flow from operating activities. This shows the cash generated or used in the company's core business operations. Move to investing activities. Record cash flows related to investments in assets. Include cash payments for purchasing fixed assets like property, plant, and equipment, and cash receipts from selling these assets. This section shows the cash impact of investments and asset disposals. Include financing activities. Document cash flows related to financing. This includes cash received from issuing shares or borrowing and cash paid out for dividends, repurchasing shares, or repaying debt. This section reveals how the company finances its operations and growth. Compile the cash flow statement. Aggregate the cash flows from operating, investing, and financing activities to determine the net increase or decrease in cash for the period. Add this to the beginning cash balance to arrive at the ending cash balance. Review and verify. Ensure that the cash flow statement reconciles with the changes in the cash balance reported in the balance sheets. Cross-check the figures with supporting documents to confirm accuracy. By following these steps, you can construct a detailed cash flow statement that provides a clear picture of a company's cash generation and utilization.